What's up, guys? Camp Kite. So listen, I want to talk briefly about cash your putts. Cause a lot of people ask me about the strategy. What if I told you you could get paid for potentially buying a stock? Potentially. What if I tell you can make passive income by simply just inquiring stocks? Let's break it down. So this is Open Door. A lot of people might be interested in Open Door. A lot of people are not interested in Open Door. But let's just say you say, Dion, I like Open Door. Uh, I'm interested in buying it. It'd be cool. You know what I mean? I see some top potential. But Dion, I don't want to just buy it. I want to get paid to buy. I want to get paid for potentially buying a stock. And that's when cash coupons come through. Only thing about cash coupon is you actually need collateral. So you know what options is it's like a bulk of 100. So you got to buy 100 shares of a stock or selling 100 shares of a stock. For cash coupon, what you're pretty much saying is I'm willing to buy 100 shares of a stock if the stock go down to a price that I like. And that's the key thing. Go down to a price that I like. For example, Open Door is $7.14 per share. So if I want to buy 100 shares, it'll cost me $714. But let's just say you're like, you know what? I want to buy Open Door, but I don't want to spend that price. I want to shave 14 cents. I want to buy it at $17. And guess what? If the stock go down to $7, congratulations, you own the stock that you wanted at a discount and you got paid for it. The cool thing about cash coupons is this is if the stock don't go down to that strike, guess what? You keep that money that the stock market is going to give you just for participating. So imagine getting paid for just participating. That's the key thing. Just for participating, just listen, you might not even own the stock, but you can make money if the stock go down to that price or if it's there above that price. Just go to the chart. So this is Open Door. Just say in the next 2 weeks I wanna own Open Door, but I want to spend $17.14. I'm willing to do $7. So I do sell a put at the 17 straight. If Open Door stay above $7, guess what? I keep that free rental participation money that they're gonna give me. If it drop below $7, now I'm forced to buy 100 shares of a stock that I was gonna buy anyway. So again, trade options. Let's do 2 weeks out. Let's do October 31st, Halloween. All right. So listen, it's gonna pay me 54 cents per share, but it's 100 shares, but $54. They're gonna pay me $54 just for participate, just for maybe considering buying a stock. So the max loss is $646. You might be asking me, Dion, how do you get that max loss? That max loss is because they're paying you $54 regardless what happened. The stock go up, you get $54. Stock go down, you get $54. The $646 the collateral they're gonna ask for you. So to buy 100 shares of that stock is gonna cost you $714. But they're giving you $54. That's what your max loss is. So what I'm trying to say is that $54 is yours regardless. The stock stay above 1740. Sorry, if it stay above, yes, $7.14 a share, you keep that full premium. If the stock go below that price, you gotta buy them shares. But listen, you're just gonna buy them shares anyway. But the cool thing about it is that $54 is yours regardless. So once you get in that option contract, that $54 is going to your account regardless of what happened. Now let's think if you had, I don't know, 50 contracts. 32,000. If you had $32,000 in cash, you could make $2,700 in 2 weeks just for maybe considering buying the stock. If Open Door stay above $7.14, you get your collateral back and you keep that $2,700. That's if you had $32. But let's go back down if you only had one contract. So max loss $646. Now the reason why it's a max loss, because if you gotta own this stock rate and it go to zero, that'd be the max loss. The most you can lose, the stock go to zero is $646. Will the stock go to zero? Most likely, it won't go to zero. But the key thing is that $54 is yours regardless. If the stock go up, down, sideways. This is a cool thing with cash card puts. listen. I refuse to buy a stock unless I'm doing a cash cure put. Unless I'm trying to rush in a play or something. But I always do cash cure put to accumulate shares. Why? Because why not get paid for buying stocks? This is stock market. This game is to make money. Why would I want to buy 100 shares of Open Door for $714 while I could do a cash cure put, get paid if the stock go down to my price? Now listen, not only you getting paid a premium for this position, but you also buying a stock that you love at a price that you agreed to. Let's go back. Let's backtrack a little bit. Let's just say you do the $16 straight. The odds of Open Door going from $7 to $6 in 2 weeks is not likely. But this is how a lot of people collect free premium without risking any money. Alright, so for $584 max loss, I can make $16. This stock got to go back. Listen, this stock got to go back almost 20% for me to own them shares. So what a lot of people do is they find a stock that they don't mind owning, but they really don't want to own it. They find a strike price that they know the stock won't go to. They collect free money, and that's another great strategy you can do. But the only thing about it is this: you gotta have the collateral. I gotta have $584 in my account to make that $16. You might be thinking, Dion, $16 is not a lot of money. $16 is not worth me risking $500. The thing is, this is the odds of it. The odds that you gotta own that stock if it dropped 10 or 20% is not likely. Number two is you only doing this for stocks that you really don't mind owning. That's what's so great about the cash cure put. So again, cash cure put is you getting paid a premium for being interested in buying a stock. The stock go down to your strike price, yes, you be forced to buy them shares. Don't use your collateral to buy shares. If it stay above that strike, you get your collateral back, you keep the premium. Got any questions, hit me up. It's Camp Cut, and I'm out.